The Federal Reserve, they have been hiking rates and causing a global currency crisis. However, we have reached a point where the tables have turned. The biggest buyers of US Treasuries have now done a 180 and they are selling. The effects of the Fed's tightening are now boomeranging back and building enormous risks in the bond markets. And according to reports, big Treasury whales, including Japanese pension funds, foreign governments, and even US commercial banks, are exiting Treasuries like they are toxic assets. And this is a consequence of a global dollar shortage that is spiraling out of control. When you have the dollar rising non-stop for nearly a year, global currencies are getting devalued to the ground. And when you add in rising bond yields to the mix, now you have a recipe for a sovereign debt crisis back in the United States. The Fed's next crisis could very well be in the treasury market, right? In fact, we are seeing some of the worst treasury sales over the past few months. It's headline after headline of bad news. People are just not interested in holding US debt. We have treasury auctions performing poorly and liquidity is starting to dry up. And when the market smells weakness and blood in the water, they strike. Just last month, treasury yields surged up as weak demand in the 2-year auction triggered a massive sell-off. And that's why we see this crazy spike up in bond yields. Liquidity is dropping and bondholders they are heading for the exits because if they don't sell now, there might be no buyers on the other side very soon. Now, treasuries are supposed to be some of the safest investments out there, but it is now a risky bet. Investors normally flock to US bonds during a recession, but things have changed, guys. The biggest holders are now dumping their holdings to stay afloat. It's about survival for them. But it is this very liquidation of treasuries that could trigger an epic bond crash that could force the Federal Reserve to pivot and save the market. Jerome Powell could very well do a Bank of England QE if the bond market breaks. But to understand the gravity of this situation, we need to realize why the whales are dumping US debt. Now, for countries, the main reason is very straightforward. They are trying to protect their currencies and prevent their local inflation from soaring to the moon. Now, just remember that 70% of global trade is done in US dollars and 60% of foreign debt is also issued in the dollar. And with the Fed hiking rates month after month, the dollar is getting stronger and other currencies they are getting devalued. Now, just take a look at the dollar index. It has been on the rise for 10 months straight, and the world is afraid it will keep going up. So there's a mad scramble for US dollars because if you're an importer of commodities, which most countries are, you need dollars to buy food and fuel. Plus, when it comes time for your bond payments, you need dollars as well. And here's the cruel joke. The more dollars they buy, the dollar shortage becomes worse and that feeds into a stronger dollar. And that in turn crushes their local currency even more. And on this goes. And that's why we are seeing record currency depreciation in emerging economies. The Sri Lankan rupee is down 78% and the Turkish lira has crashed by 31% because of the mad rush to dollars. So there's this vicious cycle, a kind of doom loop that countries they are stuck in. And to exit this trap, they only have two choices, right? They hike their own rates to destroy demand so that everyone is broke, or they can sell off their dollar reserves to stay afloat. And that is exactly what many countries are doing today. We have a record $1 trillion drawdown in world currency reserves. Japan has been aggressively selling their dollar stockpiles, liquidating 54 billion in September, bringing their reserves down to the 2017 lows. And this is happening globally, guys. And here's the thing. Countries have a limited amount of dollar reserves. They are not the Federal Reserve, which can just print dollars. Sooner or later, they're going to run out of greenbacks and they have to sell their treasuries for dollar cash. Yes, if governments dump their bond holdings, they will take a loss, but they don't have much of a choice. We have inflation rising by 0.4%, coming in rate hot at 8.2% for September. And this is making Powell look really incompetent in this inflation fight. And this means more rate hikes are coming and bond values are going to crash even further. Countries might very well start to front run the Fed before they hike and squeeze as much value by selling first. After all, they still need dollar cash to defend their own currencies, right? And when it comes to pension funds and banks, they are also dumping treasuries like hot potatoes. We have Japanese life insurers dumping foreign debt because bond prices are collapsing. They have to limit their losses. And the problem with many pension funds, banks, and insurers is the need to deliver a minimum return to their customers. I'm sure you're familiar with insurance policies that lock your money up, right? They guarantee you maybe a 1 or 2% annual return every year, plus you're also guaranteed your capital. And that means they have to be conservative with their investments, right? Where do you think they invest in? Many of these guaranteed plans invest in US Treasuries, especially the Japanese funds, because the yields are a joke when it comes to Japan's own local bonds, the JGB. Now, the 2-year JGB is yielding negative, the 5 years at 0%, and even the 10 years less than a quarter of a percent. That is why all these insurance companies were buying up tons of US Treasuries in the past, because this was the thought process, right? Treasuries are safe investments. They are yielding much more than my local bonds, and the only risk I have is currency risk. However, they forget that treasuries also have principal risk. When yields go up, bond values crash. And here's the truth about guaranteed capital plans, they are only as solid as the insurer themselves. If bond values crash hard enough and an insurer becomes insolvent, policy holders could be left holding the bag. And what are we seeing today? The Fed is raising the benchmark rate and the demand for treasuries have collapsed, right? Bond values are crashing to hell. And this is why we have pension funds, insurers, and banks running away from treasury auctions. In fact, they are dumping their bonds because there's no fundamental case to hold treasuries. Why buy treasuries today when the yields are going to keep rising? If I buy a 10-year treasury, Powell is going to screw me next month when he hikes rates. My bond value will crash, and if my customer asks for their money back suddenly, plus I have to guarantee it, right, I will have to eat the loss. And this thinking is spreading across Wall Street and the world. There's a sense of fear when it comes to buying bonds, and fear is very contagious. But this is just the tip of the iceberg. A big systemic risk is now building in the US bond market. We have already seen from the recent UK bailouts that even pension funds had been using leverage on their British bond holdings. They were playing with derivatives on old people's money. Just think about that. Yields were so low that they had to use leverage to deliver adequate returns. And to be honest, we all should have seen it coming. How could a pension fund deliver a 3 to 4% return in 2021 when the 10-year British gilt was yielding at most 1% at that point of time? Why were they so confident that they could deliver 3 times the return? And that's because they were using leverage and they believed the demand for bonds would always be there. And this is the big problem with the traditional thinking that bonds are safe. They are extremely safe and liquid until they are suddenly not. And if you're using leverage, your phone will be blowing up from all those margin calls. Now just take a look at the 10-year gilts. The yield suddenly soared from 1% to over 4% in just 9 months or so. And that's why British pension funds were imploding and the Bank of England had to step in. Guys, we are now in Twilight Zone economics. The old rules are getting rewritten. Past performance is not indicative of future returns. And this is why there could be a meltdown coming for the bond market. We don't know how deep this leverage hold goes. How many bond derivatives are just floating around in the ether? Every time yields go higher, this time bomb gets closer to exploding and causing a market meltdown. And right now, we also have the Federal Reserve deleveraging its balance sheet. They are doing quantitative tightening. A lot of people, they are forgetting this. Since September, they have been selling up to $60 billion worth of treasuries every month. And we don't know how long this will continue. We can see they are starting to reduce their bond holdings. They have sold at least $200 billion from their peak of 9 trillion. And this is also putting pressure on the yields to go up. Remember, the Federal Reserve wants to push yields up to cause demand destruction. Their number one priority right now, the number one enemy, is inflation, especially when the midterms are coming up and the Saudis aren't playing ball. Powell probably knows his actions are pushing the bond market to breaking point, but he has no choice. He has to pull money out of the system by hiking rates and selling treasuries. And here's the inconvenient truth. Right now, the bond market is sitting on a powder keg and it's all about confidence at this point. And if a meltdown happens, the Fed might be forced to step in and buy up all the unwanted treasuries just to stabilize the market. They will be the buyers of last resort. The Treasury will deliver all their bonds to the Federal Reserve and Jerome Powell will print out a bunch of money to give to Janet Yellen. And right now, we are back to debt monetization all over again, which is money printing. Yes, the markets will stabilize, but this will unleash the inflation demon. But here's the cruel joke. Investors won't tolerate this. They are not stupid. They already know the Fed is artificially supporting the Treasury market. Just back in 2021, the Fed had $5.3 trillion worth of US Treasury bonds. That's over 18% of the entire market, right? One institution is holding 18% of the world's biggest bond market. And if the Fed starts increasing these to 30% or even 40%, the bond market will be finished. Investors will suddenly wake up from fantasy land and realize that this isn't organic demand from the market. It is the Federal Reserve trying to prop up the house of cards. And ironically, this could trigger yet another sell-off of treasuries that will spike yields even harder. The Fed will be forced to buy even more bonds until they become the biggest holder of US debt. Because if the Federal Reserve has to buy all these treasuries, right, that means other investors are unwilling to lend money to the US government. And even JP Morgan is afraid of who is going to buy the bonds. They know demand is cratering. And for you and me, this means inflation is going to soar again. When the Fed buys bonds, they increase the money supply. And it's a very simple equation. More dollars chasing fewer goods means higher inflation. Even a monkey knows this by now. This is what happens when a market gets too big and everyone relies on it. When momentum shifts, the pain can get magnified, especially in our world of derivatives. Because one big sell order could very well set up a whole trail of other sell orders, and then the whole bond market collapses on itself. It has already happened in the UK, and the United States is not immune. And if that happens, we could be in for a Fed pivot. It will be an inflationary pivot that will save the market at the expense of all existing dollars. The dollar will lose even more value. So we have to hang tight as rates go higher, guys, because if something breaks in the bond market, the Fed will have to step in. It will be a systemic collapse because modern finance all depends on the bond market. If the market crashes and yields spike, suddenly borrowing costs could double or triple from what they are seeing today, right? And it will spiral into a Great Depression because companies can't borrow and people will get too afraid to spend. Now, I still stand by my belief that a Fed pivot will likely come once unemployment starts to soar. Once people start losing their jobs, I believe the Fed will at least take a pause on rate hikes to recalibrate. However, if the bond market suddenly collapses and it breaks down, then all bets are off. Jerome Powell will have to step in and save the day. Maybe he'll reset the Fed funds rate back down to 1%, or maybe he'll really go in and buy up all the unwanted treasuries. Either way, the Fed will have to choose between persistent stagflation or a depression, and chances are they will kick the can down the road and save the market. So now we have to pay attention to the bond market in addition to unemployment, because something tells me there's a lot of leverage and derivatives hidden from plain sight. Let's hope I'm wrong and pray the market doesn't break. So let me know what you think. Is the bond market really in trouble? Let me know in the comments below. Stay safe, be sure to smash that like button and subscribe as we navigate through these crazy times.